Hey, welcome back to my Mortgage Advocate. Today is going to be a good one. This video, I'm going to break down the loan estimate, how to use it to do a fair comparison between lender offers, little things to look out for when you're applying. So grab your favorite beverage of choice and let's do this. For those of you finding the channel for the first time, welcome. I am a notary that does real estate closings for a living, and the goal of this channel is to make you better educated on the mortgage process from start to finish. I'm going to tell you things that loan officers or other parties to the transaction wish I wouldn't. So for that reason alone, you should consider subscribing to this channel. For this video though, timestamps are in the description, so feel free to skip to the section you are looking for if you choose not to watch the whole thing. Alright, so let's get into it. So first order of business, what exactly is a loan estimate? It's a 3-page form that you receive from a lender or a mortgage broker after you've applied for a mortgage. It tells you important details about the loan that you have requested, provides you with important information such as the interest rate, monthly payment, and total closing costs for the loan. It details the estimated cost of taxes and insurance, and how the interest rate may change over time. It also includes any special features of your loan that you will need to be made aware of, such as any prepayment penalties, the need for mortgage insurance, any balloon payments, etc. All lenders are required to use the same standard loan estimate form, which I'm going to show you throughout this video. I've included a link in the description on where you can download a copy of these examples if you wish to follow along. Next, let's talk about the who and when. Who is supposed to receive it, and when are you supposed to receive it? Anybody applying for a regular mortgage through a creditor is supposed to receive a loan estimate. There are exceptions to this, like if you are applying for a reverse mortgage, you will not receive a loan estimate. Instead, you will receive two different forms, a good faith estimate and an initial truth in lending disclosure. The good faith estimate, or GFE, was what was used prior to the loan estimate being implemented back in 2015. Also, if you're applying for a home equity line of credit, also known as a HELOC, a manufactured housing loan not secured by land, or a loan through certain types of homebuyer assistance programs, you will not receive a GFE or a loan estimate, but you will receive the truth in lending disclosure. Now, when are you supposed to receive it? The lender has to provide it within 3 business days of receiving your loan application, and it must be at least 7 days before loan closing. Most will send it to you electronically, but if you don't have email or a way to download it, they can mail it to you. If it's mailed, it's considered to be received by the borrower 3 business days after it's mailed. The 3 business day deadline includes every day in which the lender's offices are open for business, and for mailed copies, it includes the days the post office does mail delivery. Also, when there is a changed circumstance, such as a change to the loan type or loan amount, the lender is supposed to send you a revised loan estimate within 3 days as well. We'll talk about valid changed circumstances later in this video. Now here's where it gets interesting. The loan officer is required to provide a loan estimate once you've provided the following things: your name, income, social security number so that they can pull your credit report, property address. If you are house hunting and have not entered into a contract for a home, that's okay. The address would be considered TBD. Estimated value of the property and desired loan amount. Once you have provided these details, they are required to give you the loan estimate. So technically, you don't have to have a completed application before they're supposed to send it to you. Now, should you give them more information? Of course. Letting them know what you want, such as a fixed rate or an FHA, VA loan, whether you want to have lender credits available for closing costs, etc. It's going to help you get the best deal that is available to you, and the more accurate your loan estimate is going to be. Once you have received the loan estimate, the charges on the loan estimate must be valid for at least 10 days from the date of issue. So that basically gives you 10 days to shop around from other lenders using the same loan estimate. So here's a tip. Starting with the first lender pull on your credit report, You have a 45-day window to shop around and get loan estimates. The credit score algorithm counts all of those inquiries as a single inquiry, so don't worry about taking a hit on your credit report. It only counts as one. We don't know a whole lot about that algorithm, but we do know that. Okay, so I need to say one thing before we get into the main topic of this video. Just because you have received a loan estimate does not mean your loan has been approved or denied. The loan estimate is supposed to show you what the loan terms are expected to be if you decide to move forward. If you do decide to move forward, the lender will send you a letter called the Acknowledgement of Intent to Proceed. This is the official "let's move forward with my application" decree. So far, we have talked about what it is, the who is supposed to receive it, and the when. When are you supposed to receive it? Now let's talk about the how. How is it broken down? First, let's take a look at page 1. So I have two different versions of the loan estimate. The one on screen is for a fixed rate loan, while this one right here is an adjustable rate loan. So I'm going to use the fixed rate version as a reference, but we'll pull up the other one when I want to cover something specific to that one. Starting here at the top, you have the bank or lender information. On the right, it says, save this loan estimate to compare with your closing disclosure. Put a pin in that. I'm going to tell you why towards the end of this video. Then we have the date. This is the date the disclosure is considered delivered, not the date it was printed. So next is the applicant information. Each applicant is listed here, along with the mailing address of the applicant. If there is a trust involved, it'll be the names of the trustees that are listed here. Also, let me interject and say this about the names. This is your opportunity to make sure the spelling is correct and that the name matches what you want it to be on the loan and on the title. So if you want your middle name, initial, junior, senior, anything specific you want on that name, make sure the lender has it correct at this point. Once you get into the verification phase of the process, you'll be asked to provide a copy of your IDs, copies of the trust to verify the name. So it can't be a nickname unless unless it's what you have on your IDs. I cannot emphasize this enough. Check the spelling. I have seen so many times at closing where there are issues with the name and we're unable to close due to a mismatch in spelling, in the names, etc. All because it was never verified by the borrowers that it was correct. All right, continuing on. We have the property address, if it's known. And then you also see sale price. If you're buying a home, it'll say sale price. If you are refinancing, it'll say estimated property value. It could be the value you provided them, or it could be a value that the lender has calculated for that particular address. Then on the right at the top, you have the loan term, 30 years, 15 years, 20 years, etc. The purpose, so purchase, refinance, if it's a construction loan, or if it's a home equity line of credit or HELOC, it'll say one of those four things there. So now for full disclosure, I'll pull up the adjustable rate estimate. Product type, fixed rate, adjustable rate, or one of the special products. And I'll go more into detail on those when we get to page 2. So in this particular case, you have a 5-year interest-only loan followed by a 5-3 ARM type. So what exactly is a 5-3 adjustable rate? It means that the first 5 years of the loan are at a fixed rate. All right? In this case, it's also interest-only. So starting at year 6, the rate can be adjusted and then be adjusted every 3 years. All right. Next, you have the loan type, conventional, FHA, VA, USDA, or some other loan type. Make sure this matches what you discussed with your lender or broker. Then we have the loan ID. So this will be your loan number throughout the process. And then below that, you have the rate lock section. So in another video in the future, I'll talk rate locks, but for now, let's just stay on point. In this example, you do have a rate lock and the expiration date, which is 60 days after the date of this disclosure. That's typical. You should be able to close on your loan in much less time, unless there are issues discovered, such as property liens or contingencies that fail to materialize for the sellers. Now, if you do not have a rate lock, it does say here, before closing, your interest rate, points, and lender credits can change unless you lock the interest rate. All other estimated closing costs expire on, and then the date of expiration. So that begs the question, should you get a rate lock? Keep in mind there may be a fee associated with it, and the fee varies by lender. So you'll need to keep that in mind. If you don't get a rate lock, it can change at any point between now and closing. Again, I'm not a financial expert. I'm here to give you the facts and an occasional opinion. In the end, it's up to you to determine what's right for your situation. Okay, let me switch back to the other one. And now let's look at the loan terms. All right, so you have the loan amount. If you're buying a home, make sure that the loan amount plus your down payment and any earnest deposit equals the sale price. If it does not, ask your lender why. Next is going to be the interest rate. This is the initial rate at time of closing. Monthly principal and interest. This only includes principal and interest. It doesn't include any amount for taxes or insurance. And then on the right it says, can this amount increase after closing? If you have a fixed rate loan, then all three of these should say no. If you have an adjustable rate loan, the last two would be yes. And if you have a negative amortization loan or some other special program, the first would also be yes. All right, let me switch over to the other estimate, and we'll take a look at those. So for interest rate, this says yes. It can adjust every 3 years, starting at year 6. It can go as high as 12% in year 15, and I'll explain why when we look at the AIR table on page 2. And then for monthly principal and interest, it adjusts every 3 years, starting in year 6. Can go as high as $2,068 in year 15, and that's if it hits that 12%. Includes interest only and no principal until year 6. And again, let's take a look at it when we get to page 2. All right, so let me go back to the other one. Okay, next you have prepayment penalty. In this example, it says yes, that it can be as high as $3,240 if you pay off the loan during the first 2 years. But I'm going to let you in on a little known fact. And this is why you should subscribe to this channel and like the video if you haven't done so already. Because nobody's going to tell you what I'm about to tell you. All right? Most lenders have done away with the prepayment penalty. Why? Prior to the meltdown in 2008, these types of clauses were prevalent. But because the government had to do a bailout, they basically put new rules in place. So now there's something called a qualified mortgage. And this applies to all lenders of residential mortgages. And it basically says that if you want legal protection, if the borrower later goes into foreclosure, your loans must meet a list of criteria. And most important among those is that the borrowers must have the ability to repay, and you as the lender must verify that. So if you've ever wondered why lenders scrutinize tax returns, bank statements, income, that's why. The full list of that criteria is outside the scope of today's video, but I promise I'll cover it in another video. So one of the criteria is that prepayment penalties are prohibited, all right, except for certain fixed rate qualified loans. Now, of course, lenders can do whatever they want, but if they want the government to offer them legal protection, if the mortgage defaults, they must meet all of the criteria for that qualified mortgage. If they don't, then they're on their own. All right, so it's rare that you will see a lender offer a mortgage with a prepayment penalty. Okay, and then the last one there is a balloon payment. Now, what is a balloon payment? It's a large one-time payment at the end of the loan, usually tens of thousands of dollars. So in essence, it reduces your monthly payment throughout the term, but it hits you on the back end at the end of the loan. Fortunately, this is also not allowed in a qualified mortgage with very limited exceptions. All right, now let's move on to the projected payment section. Okay, so back on the fixed rate one, we have 2 columns. The first says years 1 through 7, and the second says years 8 through 30. The principal and interest is the same in both columns. Then in the first column, you have $82 for mortgage insurance. So what is mortgage insurance? First, it is not your homeowner's insurance that protects you when there's damage. Mortgage insurance is a policy that protects the lender in the event that you fall behind on your payments. It lowers the risk to the lender so that someone that doesn't have optimal conditions or someone that is using one of the government programs can get a loan that they may not otherwise qualify for. Maybe you have a lower credit score, or you don't have the 20% for a down payment, etc. So you may have heard the acronym PMI. That stands for Private Mortgage Insurance, and is a mortgage insurance policy issued by a private company. And it's used with conventional loans. All right, so FHA loans or USD loans have mortgage insurance that are paid directly to the Federal Housing Administration. VA loans don't have a mortgage insurance policy, but you pay a upfront funding fee. The topic of mortgage insurance is on my list of video topics to cover, so stay tuned for those. So in this example, you have mortgage insurance for the first 7 years, and then it gets dropped in year 8. Then you have the estimated escrow section, and you see underneath it, it says that the amount can increase over time. In this example, it's $206. You see the section below the total line where it says estimated taxes, insurance, and assessments. You see on the right of that the 206 amount includes the property taxes and the homeowner's insurance. If the property has a HOA or it's part of a condominium, under other it'll say HOA or condo association or something to that effect, and then whether it's included in your escrow or not. All right, so the detail of the amount is broken down on page 2, and you all can also see the statement below that. You must pay for other property costs separately. In my experience, you see the majority of lenders opt to not include the HOA dues as part of escrow. So you would normally see no on the right of that where it says in escrow. One more thing I want to point out, if you do have an HOA, and for example, say the dues are $50 a month, where you see the 206 a month in this area right here, it would show 256. So you add the 206 to the 50, you get the 256. All right, so the estimated escrow above is only what is being collected for escrow, and then the section below it says what is included in escrow. The estimate below is for all additional taxes, insurance, and assessments, including your HOA. So I wanted to bring this up because I've seen at closing that this confuses people. So it's something to keep in mind when you are reviewing your loan estimates. All right, so let's talk briefly about escrow. The terms of the loan, such as the interest rate, the initial loan amount, the fact that there is escrow. This all has to do with risk, specifically the amount of risk the lender is willing to take. So if you're buying and you have an excellent credit score, and you've got more than the 20% to apply towards a down payment, all of these terms are negotiable, including the fact whether you have escrow or not. So if the lender feels comfortable in the fact that you can pay your insurance premiums and your property taxes in one lump sum and on time, they may be willing to waive the escrow requirement. Some lenders charge a fee to do this, but it doesn't hurt to ask. All right, so now if you're someone that can't necessarily come up with, say $5,000, for example, to pay the tax bill when it comes due, you should definitely look into doing escrow. You're paying the premiums and the taxes with each monthly payment, and the servicer of the loan is the one that has to make the full payments when they become due. So it's one less thing to worry about. Okay, so before we look at the bottom section, let's switch back over to the adjustable rate loan estimate. So in this one, there's 4 columns. The first one is for the first 5 years and includes the interest-only payments. Mortgage insurance is $109. Total is $812. Then the next column is for years 6 through 8. It says the minimum principal and interest payment is going to be $1,028, and the maximum principal and interest payment is going to be $1,359. Because remember, the interest rate can change starting in year 6. Again, mortgage insurance is $109, and the total is between $1,137 and $1,468. Next column starts at year 9. Remember, they can adjust the rate every 3 years. So this would be the point that it changes again. So as you see, there's a pattern here that every time the payment changes, or potentially can change, there's a new column. They can only do 4 columns on the sheet, otherwise you'd end up with a spreadsheet instead of a loan estimate. So that's why the last one is years 12 through 30. So now in this particular case, there is no escrow being collected, but down below it says the estimate is $533 a month. And that's what I was trying to explain earlier on the other estimate. That on this you can see where on the right it says in escrow, the answer is no for all of these. Okay? So let's go back to the other one and look at the bottom section. Costs at closing. The first one is the estimated closing cost. And you see it says it includes $5,672 in loan costs, plus $2,382 in other costs, minus $0 in lender credits. This is a summation of the detail we're going to see here shortly on page 2. Next is the estimated cash to close. This is the estimated amount that you will need to bring to closing. This includes your closing costs, down payment. Again, we'll see the detail on page 2. If you're refinancing, you're doing a cash out, this is likely going to be a negative number. Okay, so enough teasing. Let's get over to page 2 and take a look at the detail. Okay, so we have 2 columns and 3 sections. On the adjustable rate 1, there are 5 sections, but we'll get to those later. The first section here is the loan costs. So let me say this. Anything in the loan cost section can be negotiated. If you see something that appears to be high, ask the loan officer about it. Sometimes merely asking about a certain fee can reduce it or eliminate the fee altogether. And don't be shy about it either. Remember this, the lender that ends up getting your business is going to make thousands of dollars on the loan. So the mere fact that you may be asking about a $35 charge, they may be able to waive that. Moving on, let's take a look at Section A. They call these Section A charges. So when you're doing your lender shopping, this is a big one to compare between offers. You want to compare the interest rate, any lender credits, and the Section A charges. A lot of people look at the rate and the estimated closing costs on page 1, or the interest rate and the APR to make comparisons on, but you could be making a mistake. All right. Everything outside of Section A are things that are going to be required, regardless of the lender. And it may only vary by a few dollars. So if you focus only on those 3 things that I mentioned, you'll have good information to make your decision on who to go with. Okay, origination charges. Origination charges are upfront fees that are charged by your lender. They can include discount points, application fees, origination fees, underwriting fees, loan processing fees, verification fees, and rate lock fees. There are others, but these are the common ones you'll see. If you're working with a broker, you'll likely see a loan origination fee. This is how your broker or loan officer gets paid. Here you have a total of $1,802, which includes $405 for 0.25% discount points, $300 for the application fee, and $1,097 for the underwriting fee. I have a video here that explains how discount points work and how to shop them. There'll also be a link in the description so you can watch it after this video. Next section is Section B, services you cannot shop for. These are the things that are required and chosen by the lender that are performed by third-party providers. Because you can't shop separately for these with other providers, this is another section that requires some comparison between lenders. Some fees in this section may depend on the kind of loan you've chosen. These things include the appraisal fee, the credit report fee, flood determination fees, government funding fees, HOA certifications, tax status search fee, and any upfront mortgage insurance fees. All right, so as you receive multiple loan estimates from different lenders, take a quick glance at this section. Question anything and everything. So I'm going to say this again. In many cases, you may be able to negotiate these fees and get them reduced or eliminated altogether. The exception to that are the government funding fees. These are set by the government, not the lender. You'll see mortgage insurance premium for FHA or USDA loans and VA funding fee for VA loans. Again, these are not negotiable, but everything else pretty much is. So in this example, you have a total of $672, which includes a breakdown of the fees you see here. Let's move on to the next section, Section C. All right, so these are for services you can shop for. These are also for services that the lender requires, but you may choose your own providers. So depending on the loan purpose, you may see a different list of services for purchases versus refinances. The lender will give the costs based on the providers that they typically use in your area. And the paperwork that the lender sends you, along with the loan estimate, they should also send you a list of providers that they use for each of their services. I want to point out 3 things about these services. 1, because you can shop around for these services, I would give these costs less weight when you're doing your lender shopping. If you get a better deal from another lender, but the services in this section are higher than the others, you can always go with the other providers to get those even lower. All right, so second thing I want to point out is that even though you can shop for these, doesn't necessarily mean you should. One thing that the lender has going for it is volume. So they do plenty of business with these providers, and so the providers usually offer them the best rates. So yes, you can shop around for them, for example, a title company, but you may not get a lower rate with that title company than the lender would get with it. So something to keep in mind. Also, if you're buying a home, your real estate agent is a great resource for identifying the providers, since they've worked with a number of these in your local area. But again, do your due diligence, because it's ultimately up to you to make that choice. The third thing I want to point out is that for some of these services, you'll probably have to pay for out-of-pocket prior to closing. Things like the appraisal fee or the pest inspection fee. Again, check with your lender. Some lenders may allow you to use the services and then they just incorporate them in your closing costs, and others will have you pay for them in advance. Again, check with your lender. In this example, the total is $3,198. All right, so let's take a look at Section D. This is a total of Sections A, B, and C, $5,672. All right, so if you go back to page 1, you'll see at the bottom that the estimated closing costs of $8,054 includes $5,672 in loan costs. So that number matches the total here in Section D. Okay, so you see that it also says $2,382 in other costs. So let's take a look at what those other costs are. Okay, Section E, taxes and other government fees. Transfer taxes are state and local government fees on mortgages and home sales based on the loan amount or sale price of the property. And whether you have to pay for that transfer tax is determined by your state or local laws. Also, if the seller is having to pay these are not listed on your loan estimate. All right, so now let's look at Section F, the prepaids. All right, the first one is the homeowner's insurance premium. If you're buying the home, you'll typically have to pay the first 6 or 12 months of the insurance at closing. You do get to choose your own insurance provider. Just make sure that the estimate there is accurate. All right, if you're buying and the sellers have paid the premiums for the year or have paid the taxes for the year, the sellers are due a prorated portion of those payments at closing. So you'll be responsible for the taxes of insurance from the date of closing forward. So the amount will be from the date of closing till the date that those premiums or taxes are paid through. All right, so if you're refinancing, you've probably paid your policy up to a certain point, so you may not have to prepay your insurance premiums. However, if it's about to be due and you or your current escrow hasn't paid it yet, then they will collect it at closing. Next is the mortgage insurance premium. I don't think I can ever recall there being anything here at closing. Usually they are listed in Section B. All right, so moving on. Next is the prepaid interest. So prepaid interest is the daily interest rate times the number of days between and including closing or funds disbursement for the refinancers and the first of the next month. So if you close on April the 10th, it would be the amount of interest on the new loan from the 10th through the 30th, so 21 days of interest. When you make a mortgage payment, you're actually paying interest in arrears, so meaning you're paying for last month's interest. So it's different than renting, because with renting, you're actually paying for the month ahead, while homeowners pay for the month that passed. So because your interest for April is included in your closing cost, The interest for May is actually your June payment. So if you close in April, your first month's payment won't be due until June 1st. Now, here's my next tip for the refinancers. All right, and again, you won't hear another loan officer tell you this, simply because it's not in his or her best interest. The best time to close on a refinance transaction is the first week of the month. Why? So let's say you close on March the 2nd. The disbursement date of the funds probably won't be until March the 6th or the 7th. So the disbursement date is the date that monies are paid out. All right, so that's technically when your new loan takes effect. The old loan is paid off. Any cash outs are paid out. Title services are paid, etc. On your old loan, the March payment would have to be made by the 15th, right? But it's now paid off on, say, let's say the 7th, right? So there won't be a March payment that needs to be made, all right? So you get to skip your March payment. So now April's interest will be in the May payment. So in essence, when you close the first week of the month, you get to skip 2 mortgage payments, March and April. So by closing on the first week of the month, you end up basically getting to skip 2 months of payments when you're refinancing. Now, the interest on the new loan from March the 7th until April the 1st will be listed here in your closing costs. So the lender's going to get their money regardless. But if you can time it just right, you'll end up skipping the 2 months of mortgage payments. So you might be asking yourself, why would the loan officer not want to tell me that? Or why is this not in their best interest? There's 2 reasons, and they're both related. First, the loan officer doesn't get paid until the loan funds. All right, so if you close at the end of March, he or she will get paid for it in April. All right, if it doesn't close until the first week of April, then they have to wait until May to get paid for it. All right, so that's the first reason. So, like I said, it's not in their best interest. All right, second, again, they don't get paid until the loan funds. All right, so that means that the loan has to close. Closing has to be completed successfully, and if you are refinancing a primary, the right of rescission has to expire before funding can occur. So any number of things can go wrong between now and closing. You could suddenly and unexpectedly lose your job. The appraisal can come in much lower than expected, thus reducing your loan amount. There could be issues with title or liens. The borrowers could change their mind at the last minute. So they want that loan to close as quickly as possible. So, about to tell you a true story here. I had one borrower tell me that he went through the refinance process simultaneously with 2 different lenders. They both gave the clear to close, and they both picked the same day to close. The borrower didn't tell either of them that there was another lender in the mix. The night before closing, he had to make a choice which lender he was going to go with. By the way, in case you're wondering, you can't close with 2 lenders simultaneously. That's mortgage fraud. I'm sure that the lender that lost out was not happy. The loan officer, I'm sure, got 0 for all of the time and effort put in. My guess is they probably got sent a bill to the borrower for all of the processing charges. That's my guess on that. Yeah, so crazy stuff. Anyway, let's move along. The last one in the prepaids is the property taxes. If the bill is about to be due, they'll go ahead and collect the taxes for that and pay them at closing. In the parentheses for all of these, you can see how many months or how many days they're collecting for, so that there's some clarity to you. Okay, so the totals for the prepaid in this section is $867. Now let's look at the next section, initial escrow payment at closing. In this section, section G, these are what will be collected to populate your new escrow account. Escrow has to be paid monthly. They can't say that we'll collect the quarter's worth of taxes on the first month of the quarter. They have to do it by month. So they'll take your estimated taxes and insurance, divide by 12 to get a monthly payment amount. It'll state how much they are collecting on a per month rate and how many months they are collecting. So let's talk about escrow for a minute. If you're buying, again, you're responsible for the taxes and insurance from the date of closing. They will calculate from date of closing to when your first payment will be due and include that in the prepaids. Then they may collect additional months to populate the escrow account for when the next bill is due. On top of that, lenders are allowed to take a 2-month cushion at closing in case their estimate was off. Now, if you're refinancing, let's say the premiums and tax bill are due January 1st, and the closing date is in April. Also, let's assume you're not refinancing with the same lender you're with now. Your first payment isn't due until June 1st, so they'll take 5 months and pre-populate your new escrow account January through May. Then they'll take an additional 2 months as a cushion at closing in case their estimate was off. Now you're probably asking, what happens to my current escrow? Assuming you're going with a new lender, the current lender will 9 times out of 10 issue you a check for the amount left in the escrow account after closing. They're supposed to do that within 20 business days of the loan being paid in full. They could also choose to pay down the principal with the escrow balance. If that's the case, check the payoff statement to see if the amount owed is reduced by that amount. If not, then it'll likely result in an overpayment, and they'll end up cutting you a check anyways after closing. So they're not allowed to keep your escrow. If you are refinancing with the same lender, or the servicer is the same for both lenders, the servicer will likely roll over the funds into the new escrow account. In that case, Section G will have minimal funds being collected, but they may still opt to collect the 2-month cushion allowable at closing. Okay, so the total for Section G is $413. Let's move on to Section H, Other. So this section includes items that you are paying to a third party at closing, and includes things like owner's title insurance, home warranties, HOA or condo charges associated with transfer of ownership, or event coverage products like debt suspension or debt cancellation. So you have a total there of $1,017 for an owner's title policy. And then Section I here is a list of total of other costs, sections E, F, G, and H. And that comes to $2,382, which matches the other costs listed on the first page. Section J is the sum of total closing costs. Below it, you'll see D plus I. That's the sum of sections D and I. $5,672 plus $2,382 comes out to $8,054. Then below that, you see lender credits. If you are receiving lender credits, you'll see that here. So J is the sum of D and I minus any lender credits. In this case, there are no lender credits, so the total is $8,054. So that takes care of the other cost section. Now let's look at calculating cash to close. Okay, first line, there is the total brought down from Section J, $8,054. Next line is the closing costs financed. If you are financing part or all of your closing costs, that amount is listed here. This would be coming from your loan amount. So if you're refinancing and are expecting zero due at closing, you're financing your closing costs with the new loan, so keep that in mind. Then any down payments the buyer is bringing, then a credit for any earnest monies that were paid at contract acceptance. In this case, it's $10,000. Funds for borrower, seller credits, and any adjustments or other credits, and you get a total of $16,054, which matches the bottom line on page 1. Okay, now that we've gone through the 3 sections on this fixed loan estimate, let's take a look at the other 2 sections on the adjustable rate loan estimate. Let's start with the adjustable pay rate table. This table is listed on the loan estimate when there is a payment change after closing that is not due to an interest rate change, or it's considered to be a seasonal payment product. So first, are there any interest-only payments? For this one, the first 5 years were interest-only, so it says yes for your first 60 payments. Next is the optional payments. Whether any of the payments due can be selected as an optional payment. I don't know of anyone that has this option. After that is step payments. This is when your payment increases at certain intervals of the loan term but are not related to interest rates. Next are their seasonal payments. Teachers would be a good example of what this would be used for. So you work 9 months out of the year, and you're off in the summer. You could set up the loan so that you only make payments during the months that you're working and not have to make any payments when you have no income coming in. Again, ask your lender about that option. The monthly principal and interest payments. Remember, this one is interest only for the first 5 years. So starting with the 61st payment, the borrower starts paying principal. So the amount of the 61st payment will be between $1,028 and $1,359, with any changes coming every 3 years, maximum payment being $2,068, starting on the 169th payment. How these amounts are calculated are determined in the next table, which is the adjustable interest rate table on the right. So let me say this. If you have no interest in an adjustable rate mortgage, you can skip to the next chapter of the video where I start talking about page 3. If you do, then let's talk about this table here. So the first line, there is index plus margin. The index they're using here is MTA, which stands for monthly treasury average, and the margin is 4%. So they take whatever the rate is of the index at the time of the change and add 4% to it. So that's how you read that. The next line is the initial interest rate, so it's at 4%. Next is the minimum and maximum interest rates, which are 3.25% and 12% respectively. And then below that you have the change frequency, the first being in month 61, and then every 36 months after the first change. So let's go back to the minimum and maximum rates. Say 5 years from now, when the first change is due, the MTA index reaches 8%, right? So the interest rate would become 12%, right? Not quite. Here's why. There's a limit on how much an interest rate can go up or down. So this is designed to prevent payment shock when the adjustment is made. Can you imagine having a 4% mortgage and then all of a sudden it becomes 12%? You'd be talking an additional $1,000 or more per month. The limits per change are listed at the bottom. So the first change, it cannot go up more than or down more than 2%. So in month 61, the interest rate can be between 3.25, which is the minimum interest rate, and 6% because of the cap on the amount of change. So the monthly payment for an interest rate between 3.25% and 6% is $1,028 to $1,359, which is what we saw on the last table. All right, so let's say it then gets to 6%, and then 3 years later, it can go back down to 4% or go up to 8% or anywhere in between. So 2% is the amount of any subsequent change. If eventually the rate gets to be 12%, the payment would be $2,068 after year 14, and to get there, it would have to go to 6% after year 5, 8% after year 8, and then 10% after year 11, and then 12% after year 14. So that takes care of page 2 of the loan estimate. There's a lot of information there to digest, so let's move over to page 3. At the top, we have the lender, loan officer, and mortgage broker names, and their NMLS license numbers. NMLS, by the way, stands for Nationwide Multi-State Licensing System and Registry. Every lender, every loan officer, every mortgage broker has to be licensed, and this is their license number. And then you have their contact information below that. Now let's take a look at the comparison section. These are meant as tools to help you compare lender offers. The first one shows you how much you'll have paid in the first 5 years of the loan and how much of that is principal. Next is the annual percentage rate, or APR. What this number truly is the interest rate plus the total of your closing costs represented as a percentage of the loan. This number was intended for you to use as a comparison between lenders of the true cost. So next here is the total interest percentage, or the TIP. This is the total amount of interest paid over the life of the loan as a percentage. So if you borrow $100,000 and your total interest after 15 or 30 years comes to $50,000, then the total interest percentage is 50%. To get that calculation, you take the total interest and divide by the total principal. In this loan estimate example, it's 69.45%. So now let's look at other considerations. First is the appraisal. The lender determines if there is an appraisal that is required. You'll have to pay for it. Either they will collect it from you early on, or like I said, they can add it to your closing costs at the end. Either way, you're paying for the appraisal. Now, what if the appraisal comes back and you disagree with the findings? Well, you can always dispute it, or you can also order another appraisal. If you choose to dispute it, the dispute needs to be based on material facts, such as, they only reported 3 bedrooms and you have a 4-bedroom house, or they only reported 2 baths and you have a 2.5 bath, etc. Or, square footage is incorrect. Something factual. Something they can review and correct. So if it's based on the opinion of the appraiser, good luck getting it changed. So next is going to be assumption. It says if you sell or transfer this property to another person, we will not allow assumption. They won't let the new person just take over the payments. So obviously, if you sell it, the buyers will need to take out their own loan to pay for it. If you're transferring to a relative, they will also need to take out a loan to cover the payments. So homeowners insurance. Every home with a mortgage on it requires homeowners insurance, and the policy has to meet certain criteria as defined by the lender. You're able to choose your own insurance provider, but it must meet their criteria. So all of the major insurance providers out there all meet that criteria. All right, so late payments. Lenders typically give a 15-day grace period. So on day 16, your payment is subjected to a late fee. In this particular case, it's 5%. This is 5% of the principal and interest only, not the escrow amount, and it's only for the amount that is due in that month or that is past due. All right, so refinance. Refinancing will depend on your future financial situation, property value, and market conditions. Basically, you would need to requalify if you plan to refinance in the future. And then the last one here is servicing. Do they intend to keep the loan and have you make payments directly to them, or do they intend to transfer servicing of the loan? So who you make your payments would be different than the lender you were financing from. And then the last section, confirming receipt. You would sign the acknowledgement receipt of the loan estimate, not to bind you or the lender to the terms of the loan estimate, but just to acknowledge receipt of it. That takes care of our deep dive into the details of the loan estimate. So now let's talk about revisions. All right, so when a lender gives you a loan estimate, it has to be based on an honest assessment of the closing costs that you are likely to pay, and based on information that the lender has at that time. So the lender has to provide it in good faith, right? So the loan estimate is designed to give borrowers reliable estimates of closing costs. In the past, many borrowers could find themselves surprised at the closing table when their actual closing costs were a lot higher than their estimates. As a result of that, there is a rule in place that is intended to prevent excessive discrepancies between estimated and actual costs. So they do this by setting limits on how much the actuals can vary from the estimates. The rule also states that certain items cannot change at all, and we'll get into those when we talk about the tolerances. The rule also says that the lender may not issue revised loan estimates in cases of miscalculation or underestimation of charges. They can issue revised estimates under what's called a valid change circumstance. The lender may issue a revised loan estimate when certain situations result in increased charges. Those things could include a change in eligibility, where a change in circumstance impacts your creditworthiness, such as a job change or reduced hours or salary, or affects the property in question, such as a boundary claim that lowers the property value. Consumer requested revisions you want to change the product, or you want to see what the rate would be without points, or you want to make a change to the estimate. You want to change from a 30 to a 15. You want to see what that is. That's a valid change circumstance. All right, so next one, delays caused by the consumer. So I mentioned before that you have 10 days to accept the loan estimate. So if you take 2 weeks, they can then issue a revised loan estimate. Any extraordinary event beyond anyone's control, such as a natural disaster or an act of war. Also, if one of their providers suddenly goes out of business, they can issue a revised loan estimate. And then probably the most important one, change in the interest rate. You didn't lock the rate initially, and then it changed before moving forward, or changed before closing. They can issue you a revised loan estimate. So any revision to the loan estimate, they're supposed to send to you within 3 business days. So you have 3 business days to receive the initial estimate when you apply, and then every revision results in 3 days they have to send it to you also. So you have 3 days to receive that as well. So that takes care of revisions. Feel free to go back and forth with them until you get the products you're looking for. Now let's take a look at tolerances. I mentioned earlier that there were limits as to how much more the actuals could be from the estimate. So let's talk about those now. So first are the zero tolerance items. Things that the amounts should be known in the beginning that don't have to be estimated, such as your broker fees, processing fees, credit reporting fees, anything in these services you cannot shop for on page 2, origination fees. Next, we have the 10% group, recording fees, any of the services that you can shop for, and they are on the lender's recommended provider list. So both of those have to be true. Even though a specific item on the list can exceed 10%, the aggregate amount of these charges cannot exceed 10%. And then finally, we have the no tolerance requirement list. So it can change infinitely. These includes fees for services that you choose yourself, providers that are not on the lender's recommended list, any of the prepaids in Section F, or escrow items in Section G. So this is one way how lenders can, I don't want to say deceive you, but it's borderline deception, if you ask me. This is where they can underestimate your prepaids and your escrow, your taxes and insurance, to come in with a lower closing cost on your loan estimate, knowing dang well that the final numbers that come in can be much higher, and they don't have to worry about breaking any rules with that. So that's one of the areas. That's why when I say don't concern yourself with the prepaids and the other cost section, that's one reason why. Because if you solely focus on the closing costs number on page 1, you could be making a mistake, like I said before. All right, so also, towards the beginning of this video, when we were looking at page 1, at the top right here, it said to save this loan estimate to compare with your closing disclosure. And I said I would mention why this was important towards the end of the video. This is why. You're going to compare it to the closing disclosure, which is your actuals, to see if the lender's within tolerance. So if they are within the tolerance, the lender is considered to have acted in good faith. If they exceed the tolerance, the lender is considered to have acted in bad faith. Again, I'm not an attorney, so I don't know what kind of legal recourse you have, but the CFPB doesn't make it clear what sorts of penalties could or would be imposed in such a case. All right, so that takes care of tolerances. One more thing to talk about before we discuss strategies and wrap this thing up, and that's the timeline. So the initial loan estimate must be provided within 3 business days of receiving the 6 things I mentioned at the beginning. A revised loan estimate must be provided within 3 business days, establishing a valid change of circumstance that affects your closing costs, loan terms, or any borrower requested changes. The last loan estimate must be given to the borrower no later than 4 business days before closing. This is to ensure that 7 business days must pass between the delivering of the loan estimate and the closing of the loan. So the soonest you can legally close on a home is 7 days. If you have all of your documentation and verifications available, and there's no appraisal or pest inspection to worry about, there's no reason your loan can't close within 2 to 3 weeks. All right, so that takes care of the timeline. Let's take a look at strategies going forward. So here's what I would recommend if you're just starting the mortgage process. Come up with a list of lenders to talk to. Your realtor can help you with that also. Pick the first lender you want to talk to. Before you even talk to them, consider getting a Google Voice number to provide a buffer between the lenders and your cell phone or your house phone. Because once you hit apply on the first one, you're going to start getting multiple phone calls from other lenders, sometimes within 10 minutes. I would use your Google Voice number on your applications. And then once you start proceeding with a lender, you can always have them update the phone number in the file if you want. So sit down with your real estate agent, figure out how much you can realistically afford. All right, and then talk to that first lender. Have them figure out the right product for you and your family. Can or should you do a conventional, FHA, VA loans? Get an idea of what you want. If you feel comfortable with that particular lender, start the process. Have them send you a loan estimate. Then start to review it with the concepts and strategies I talked about throughout this video. Get a baseline rate. If they send you a rate that includes discount points or lender credits, have them give you the rate without either of those. You need that baseline rate to properly evaluate offers. Then look at the loan costs on page 2. Negotiate on the loan costs. See what they can reduce or eliminate altogether. Be careful of them lowballing the amount for escrow in order to make the total closing costs look low. If your taxes are due in 4 months, make sure the estimate shows 8 months being populated into escrow, plus a 2 months cushion they're allowed to collect. I personally would say get at least 3 different estimates, preferably more. Sit down and do the analysis. Figure out which lender has the best deal. Then pick one. Also pick a second place. Go back to the loan officer and see if there's anything else you can reduce on that first one. Don't be afraid to pin lenders against each other either. The other loan officers will keep calling. I'm certain of that. Don't give them a definitive answer yet, not until you get the deal you want from the lender of your choice. Once you are satisfied, sign the acknowledgement of intent to proceed and move forward. Then tell the other loan officers who you went with when they call. Most are professional. They understand the nature of the business. They'll ask you to keep them in mind in case your first choice falls through. And so, one final thing before I summarize. Well, actually, 2. First, the only fees that a lender can charge before giving you the loan estimate is the credit reporting fee. They're not allowed to charge you for anything else until you receive the loan estimate. Second, once you move forward, unless you want to make a revision or have a valid change circumstance, the loan estimate you receive from them is likely the final one. Once you start incurring charges, such as like for an appraisal or a pest inspection, and as you start getting closer to your closing date, you'll start receiving the document called the closing disclosure. These are your actuals, and I'm certain there'll be plenty of back and forth between you and the lender on this document as well. So you'll receive multiple versions of that document. This will be one of the documents that you sign at closing, and they may have you electronically sign this document as well. Okay, so to summarize. The loan estimate is a 3-page document that a lender or broker gives you that breaks down your estimated closing costs and the estimated amount you need to bring to closing. It's designed to help consumers understand their options, avoid surprises at closing, designed to help consumers become more informed shoppers. It is to be given to you within 3 days of an application, and it's supposed to be valid for 10 days. Take a good look at the Section 8 charges. If it has discount points or lender credits, get the rate without either of those to get you a baseline in which to compare rates. Review the loan costs on page 2. This is the section that's going to vary greatly by lender. That and the interest rate. Most of the things in other costs are going to be roughly the same across lenders, even if not represented that way in the loan estimates. Shop around. Do the analysis and find the best deal for you and your family. Don't be afraid to negotiate the terms of the loan and the closing costs. The APR is the interest rate and closing costs represented as a percentage. Keep a copy of the final loan estimate to use to compare against the closing disclosure, ensuring the estimated versus actuals don't exceed the tolerances. Wow, that was a long one. I hope you enjoyed this video, and if you get value from it, please like and subscribe so we can get this information out to other people looking for a new mortgage. Have a wonderful day, and happy mortgage hunting.